Hi, I'm Brad.
I'm Meg.
And
Welcome to the Millennial Report.
it's been a whole 24 hours since our last episode. We just couldn't stay away. Got to give the people what they want after all. And what millennial investors want is ETFs.
Yep.
According to a report from CNN Money, millennials are purchasing ETFs at a faster rate than preceding generations. And further, according to the 2015 ETF investor study by Charles Schwab, ETFs makes up 41% of millennials' investment portfolios.
You may remember a previous segment we held on the basics of investing, which also made mention of the fact that trust plays a huge part in millennial investing decisions in the stock market. So it's interesting to hear about the relation between generation and exchange-traded funds, or ETFs.
ETFs. So, to discuss this further today, we have with us Jay Jacobs, who is the Director of Research at Globlades Funds, to share a bit more with us about today's topic, ETFs. Welcome, Jay.
Thank you for having me.
Yeah, sup, Jay?
Yeah, yeah, that's the millennial way to say it, right? So, tell us about Globlades.
Sure. So we are an ETF issuer, which means we create and manage ETFs. Currently, we have about $3 billion in assets under management and 50 different funds. So everything from high dividend strategies to thematic ideas to international access, so investing in specific countries.
Now that begs the question that some of our viewers may have, what are ETFs?
Okay, so we have to do a little bit of a history lesson because ETFs are like the 3.0 technology in asset management. So let's start at the beginning. This will be fun. Going back to the 1920s is the first iteration of a mutual fund, what people commonly understand as a mutual fund today. And the point of a mutual fund is it's hard for individual investors to, one, really take the time to manage a portfolio, and two, to be diversified across many stocks. So to be diversified, you need dozens, perhaps hundreds of stocks to be diversified. So what investors did was they pooled their money together and they hired a professional manager to manage this pool of money as a mutual fund, with the goal of sort of outsourcing that portfolio management, and if the portfolio manager is good, to beat the market and to generate excess returns.
Gotcha.
Version 2.0. I guess we're going from VHS to DVDs right now.
What's a VHS? Sorry.
That's a whole other history lesson.
That's the next one.
So in the 70s is when index-based mutual funds came out. A lot of academic research was showing that being diversified across stocks in this mutual fund structure was great. However, people were paying a lot for that active management. And what the academic research was showing was actually a lot of these managers were failing to beat the market. And really what the biggest component of returns was the fact that they were paying a lot of money for this management. So it sort of removed the active decisions from the mutual fund and just tracks an index, a well-known computerized index that's based off of methodology such as the S&P 500 or the Nasdaq 100. And you're just investing in an index and you're reducing a lot of those fees. So this grew in popularity, and then to stay, I guess, with the analogy here, going from DVDs to streaming is ETFs. These came out, version 3.0, came out in the 1990s. It took sort of the best of what index mutual funds had to offer, a diversified exposure at low fees, and it put it on an exchange like Nasdaq so that it trades intraday. You can buy and sell ETFs as often as you want. You can buy a single share or hundreds of thousands of shares on an exchange. It provides more transparency. It provides more flexibility to the end investor.
Very nice. Thank you for that. Now,
of course.
What are some of the most well-known ETFs?
Okay, so some of the best well-known tend to be the broadest. So as I mentioned, there's ETFs that invest in the S&P 500. It's very broad U.S. stock exposure. There's some others that provide very specific regional exposures to Europe, Japan, emerging markets. And there's some that provide access to commodities. One of the biggest ETFs invests in physical gold. So behind that ETF is really just a warehouse filled with gold.
You can't just say gold. It has to be gold or something, right?
Exactly.
Yeah.
A couple come to mind, like SPY, for example, right? That's one I'm aware of. And also PowerShares QQQ. Yeah. But those are the only couple. And I know that we're talking about millennials and how we all, trust is a huge portion of that. How are millennials investing in ETFs?
What's happened is ETFs have been out for about 20 years now. Those, the SPYs, they're sort of broad-based ETFs. Those have really gathered a lot of the assets, but a lot of the innovation in the ETF space has been about new exposures. Right. So some of the new exposures to appeal to millennials in particular is to create ideas that people sort of understand inherently in what they're investing in. So what we like to call that is thematic investing. Okay. One of the old adages of investing is invest in something you know. If you don't understand it, you won't really know when to buy it, when to sell it, what's happening in that fund. People inherently sort of understand themes better. So we've recently launched about 3 different ETFs that fall in this thematic suite, which we actually call sort of people-based themes. So they're investing in what's either happening in changing consumer behaviors or in changes in demographics.
And one of the biggest factors for investors, period, among millennials is trust. Do you see a correlation between their trust levels in ETFs and just normal stock market investing in a singular company?
When it comes to trust, I think one area that ETFs have an advantage is in transparency. So this might be more comparable to a mutual fund, but mutual funds really only have to show holdings on a quarterly basis. ETFs show them every day on their website. So you know if you're buying an ETF exactly what you're holding. I think that does a lot for trust. Also, the fact that ETFs tend to be cheaper because they are index-based rather than having an active manager, that helps appeal to millennials as well. They don't believe that they're paying more than they should for that type of exposure.
Interesting. Globlades has a new ETF that's out. Can you tell us a little bit about that?
Sure. So I think you're specifically talking about the Millennials ETF. The Millennials ETF doesn't just mean millennials should invest in it. It's about investing in basically the growing spending power of the millennial generation. So it's about investing in millennials rather than millennials investing in a specific idea. So millennials could be investors, Gen Xers could be investors, et cetera. But what we're seeing is that the millennials are increasingly becoming the American consumer. Right now, millennials range from about 16 years old to 36 years old. So you could be anywhere from in high school to sort of a young family even. What's changing, though, is that the average age of millennials are starting to enter the workforce. Income generated by millennials is growing significantly. Right now, income for millennials is about $2 trillion a year. It's expected to be at $8 trillion in the next decade.
Wow.
Millennials will represent 75% of the workforce by 2025. And there's going to be one of the biggest transfers of wealth in history from the baby boomer generation to millennials.
Right.
So what this means is millennials are going to be the consumers that are powering the U.S. economy in the next few decades. So if that was it, that if millennials behaved exactly like every other generation, that probably wouldn't matter, right? Because you couldn't invest in millennials and really distinguish between millennials and Gen Xers and baby boomers. But what we're seeing is that millennials are actually very different. Millennials like to be unique. It's sort of one of their characteristics. But if you look at them collectively, they're a generation that is very different from Gen Xers and baby boomers. They're more educated. They're more diverse. They're digital natives. They're born in this digital age. And that really influences the types of companies that they purchase from and where they like to spend their money. So with this fund, it's investing in about 70 different companies in various different categories, everything from food companies, entertainment companies, housing. But what it's looking at is if you look within a specific industry like housing, which are the housing companies that are going to do better from that millennial generation versus other generations? For example, we know millennials are very physically mobile. I don't know how many of you moved around the country a few times. Brad, you were saying that you've moved to New York in the last couple of years. So you are physically mobile. What that means for a lot of millennials is you're not buying houses, you're renting houses. And that often means you're renting from apartment REITs, or if you're a student, you're staying at a REIT that's involved in campus housing. So those are the types of companies that we include in the index.
Gotcha. So how's the reception been on the overall market?
It's been very good. I mean, what's exciting about this fund is that it's going to be dynamic over time. So millennials, as I said, they're just entering the workforce now. They're just starting to have families, to start to move out of urban centers, things like that. What's interesting is going to be what happens to this fund 20 years from now, right? Because millennials, they're going to be in their peak earning years in 20 years, but they're going to be behaving differently too. Education is not really going to be a big component of millennial spending when your average age is 40 or 50. It's going to be more about maybe raising kids or renovating a home. Millennials are really going to become a huge part of the American consumer and the fact that they're different. So this is the first sort of generational ETF we've created and that we've seen in the market. So it's pretty unique.